Erik, as we head into the second half of 2025, what's your outlook for the economy?
Yeah, the economy right now is resilient. It's slower from where we were, but it hasn't stalled. When we think about what's happening going forward from here, we're watching the labor market really closely. Right now, we're seeing unemployment claims move lower. That's a good sign. But we're seeing continuing claims tick higher. We got to watch that. And so continuing claims is a key thing to be watching going forward from here, as well as layoffs.
And you're currently overweight fixed income. You like high quality bonds. You're neutral in duration.
Right.
Why is that? Because if you're positive on the economy, shouldn't you be plowing more into stocks?
Yeah, bonds are back. And if you look at the last 10 years, we're up near the high end of the 10-year range for yields and well above the median. And that's across many different sectors. So we see opportunity there to have safety and income today. You don't have to choose between the two. And so that's why we like high quality bonds right now. On the duration front, you need to be careful. The yield curve is likely to get steeper. That means maybe the front end will come down a little bit, but the back end could move up. Watching term premiums in the Treasury market very closely.
And the wild card seems to be tariffs, both in the fixed income and the equity markets. Yeah. So how are you navigating those tariff problems or opportunities, if you will, when it comes to your fixed income allocations?
Yeah, great question, right? I think we're going to have to learn to live with some level of tariffs going forward. I think right now, all of the uncertainty around tariff headlines, we're starting to look through that and trying to look for signs of what the ending point will be. And so the way to navigate this is to understand that there's going to be some tariff tax. The businesses will likely be able to learn to deal with that. Consumers could actually change their spending patterns or maybe even decide to cut back. At the end of the day, we think it's more about stag and less about inflation when we think about stagflation.
Can we break it down a little bit further in terms of the fixed income market? There's treasuries, there's munis, there's high yield. Which area do you like the best?
So high quality fixed income, investment grade corporate, securitized credit, mortgage-backed securities, CMBS, asset-backed securities is where you have the best opportunities in the marketplace today. We're a little careful on the high yield front. We recently cut back our exposure there. We saw in April with Liberation Day that spreads widened out. They came right back in afterward. With spreads back below 300, we thought that was a great time to take a little bit of risk off the table.
And Touchstone likes to be distinctively active. What does that mean? Because for a long time, everyone was saying, just go into a passive index, but you want to be distinctively active.
Yeah, well, I think it means a couple things. One, for the equity managers out there will look at active share. When it comes to a fixed income PM, we're looking for ways to look different than the benchmark. And there's a number of ways to do that through curve positioning, interest rate, risk, sector rotation, and the like. Offers many levers to be able to add value through time. And so that's why you want to be distinctively active in fixed income.
And then finally, what are your thoughts on private market assets or alternatives? There's less liquidity there, but a lot of people are taking part of their fixed income allocation and they're putting it into these less liquid vehicles, alternatives, private market assets, whatever you want to call them. They're attracting a lot of dollars.
We're focused more on the public markets, and so let me give you an implication for the public markets. To the extent that there are certain parts of the fixed income markets that are more on the private side, direct lending, it's changed the structure of certain public sector markets. Think about high yield bonds, higher quality today than they have been in the past, better opportunities to manage risk in that space. We've actually seen a convergence in the high yield space towards investment grade. What does that mean? We should have a structural allocation there to take advantage of high starting yields and pay attention for opportunities as we move forward.
All right, well, thanks a lot for coming on and talking about it.
Thank you.